Good morning. I see that we have attendees that are joining. First and foremost, I want to welcome you. I hope you're having a blessed Tuesday. Welcome to our Women in Wealth seminar series that we're hosting today at Coral Gables Trust. We're going to give everybody a minute or two to continue coming in. First and foremost, you will see on your screen a little bit of information. I call that housekeeping. First of all, the Women in Wealth seminar series today will be conducted as a webinar. Also, when you come in, your videos and your mics will be turned off. Please note this session is being recorded. And also please note that this is being streamed live on Facebook through our Coral Gables Trust Facebook page. Also, please send your questions via the chat. So if you have any questions, please send them via the chat and we will turn on your video and the mic so that you can personally ask the question to Linda, okay? So we're just going to give it one more minute. Again, those that are chiming in, thank you so much for attending. We're so excited. We not only have one guest speaker today, we've also invited somebody else. It's a little surprise, and I'm going to introduce him. He's a wealth of knowledge and works very closely with Linda here in our office. So I will be introducing Mason Williams as well. Once again, thank you for coming. You are attending the Women in Wealth seminar series. This webinar will be conducted, the series will be conducted as a webinar. When you are coming in, your video and your mics are turned off. The session is being recorded and also being live streamed on Facebook. Please send us your questions via chat, and our team will be more than happy to turn on your video and your mic so that you can personally ask a question. Okay? Okay, so let's begin. I want to thank you all for attending. This is our 12th Women and Wealth seminar series. We are very excited. 2020 has been one heck of a year, let's just say it. And to end the year, we wanted to end it with a big bang with a guest speaker that's coming live to us all the way from Pittsburgh, who is a powerhouse in Wall Street and in the stock market and works very closely with our team here at Coral Gables Trust. But before Linda's introduced, I would like to introduce Mason. Yuli, if you could move to Mason's slide, please. Mason is our investment officer here at Coral Gables Trust, our chief investment officer. The reason I am so excited to have Mason is Mason works with the clients directly and works day to day with the Federated Hermes team here, And so having Mason in this conversation with Linda is very important to the mix. Mason has over 18 years of experience building investment strategies, and that's spectacular, and also managing institutional multi-class portfolios. So Mason, I want to welcome you to our Women in Wealth seminar series. It's wonderful that you're here, and I'm going to give you the floor so that you can go ahead and introduce our speaker today, Linda.
Thank you, Christine. It's an absolute pleasure to be here. Again, welcome everybody. Thank you for joining us today and taking your time out of your day to what we think is going to be a wonderful presentation for you to listen to and walk away from. As Christine said, my job at Chief Investment Officer at Coral Gables Trust is my main role here, and it's my team's job to find basically the best and the strongest relationships out there in the investment business. Okay, so that way we can take that knowledge and streamline it into our client portfolios that we do on a day-to-day basis. And there's absolutely no better partnership out there than Federated Hermes with us. It's been many, many years with these individuals. They're incredibly knowledgeable, incredibly informative, and they give us everything we need to do our job for our clients properly, okay? So, in the end, at Coral Gables Trust, we are the guardian and the protector of our client assets, okay? And in order to make that happen, we need to have the best of the best behind us to support us and give us that knowledge, okay? And Federated Hermes certainly fits that bill. So Linda, welcome today. Glad to have you here. Just a little bit about Linda Duessel at Federated. She is the senior equity strategist that is responsible for formulating Federated Hermes' views on the markets and the various equity portfolios that they manage, okay? Linda has been a regular contributor to CNBC's Closing Bell, as well as Fox News and Bloomberg Television. She's been extensively quoted in the Associated Press, the Wall Street Journal, Barron's, and many other periodicals. Linda discusses, she also, beyond her main role at Federated, she also takes time out of her schedule to participate in various platforms like this, where she discusses personal finance with investor groups across the country on a variety of topics. I'm sure this year she's been busier than most because it's obviously been a jam-packed year, but she talks about anything from personal finance to taxes to investing for retirement. And she has more than 35 years of that experience. So I think everybody's in for a very special treat today. Linda, welcome. Please take it away.
Well, thank you very much, Jason and Christine. Thank you so very, very much for the opportunity to talk to the group, for your kind introduction. I'm so blessed to be able to be asked to talk to this group, and sorry we couldn't meet in person. Perhaps one day we will be able to do so. As someone who, for my 35 years of experience in this business, have had the opportunity to travel the country and talk to groups like yours, it's always a particular pleasure to talk to women's groups. As a fellow woman myself, but also I find that these groups are some of the best audiences in terms of their hunger for knowledge, their willingness to, to share their views. And I'm excited for when question and answers period comes along, and we can talk together and we can talk with each other. If we had to be in a lockdown situation, if we had to go through this, thank heavens for the technology that allows us to have this. And thank you again for the opportunity, and everybody at Coral Gables Trust. I'm about to now share my screen with you all. And trust you can see it now. Yes, we can see it now.
Not yet.
Okay.
There we go.
And now, the title of my presentation, Divided We Stand. As suggested, I have a chance in my work to study a lot of topics. As I traveled the country, I normally would travel the country every week and talk about our outlook on the economy and the market. And yes, Mason, it has been a very busy year, particularly with the election, what I've described as the most dystopian election ever. And the situation that our country found itself in as we made our way into this election, feeds itself now into what we might think about the future. So this is not a presentation necessarily about the economic outcome. It's not even a presentation necessarily about politics. It is about where we are in this country as versus the world. We are divided, as we will describe. There are many haves versus have-nots throughout the economy, the market, our population and employee base, and the future will be something very, very interesting to behold. But we will stand. We may very well be divided, and we very well will stand. The United States of America is the strongest economy in the world, and we are blessed to be citizens of this fine country. Having said that, I congratulate you all for being on this call today. For the future will be very, very interesting for us in our country as citizens, as Americans, and as investors. And my fellow ladies, as I know you agree with me, we plan to live a very long time, and we need our money to outlast us, and we like to have monies to leave our heirs. And I congratulate you for being on this call. I congratulate you for having Christine, Mason, and all the people at Coral Gables to help you with what will be a very interesting future. So let's dive in to Divided We Stand. First of all, I want to say Happy New Year. Happy New Year. What a great year we finished. Who could believe that the stock market would have reached an all-time record high, which it did, as the S&P 500, as recently as just last week. And if you're someone who watches those programs on television, those financial programs, I am sure that you're hearing a lot of commentators say, this market is extremely overbought. We need to pull back from the market. And indeed, the market has expanded. I believe the last I saw, I think we were up maybe 16, 17% on a year-to-date basis. Crazy in a year that hosted the pandemic, the once in a hopefully 100-year pandemic, closing down of our economy, still not a normal economic situation. The great news about the stock market is, and something we must bear in mind, is that the stock market looks forward. The stock market is evidence not of what we know today, but of what we think will happen in the next, say, 6 to 12 months. And the outlook for 2021 this way is great. What we also have to remember is that the stock market is a reflection of our views as investors as to what corporate earnings will hold for next year. So here we are today, not just with the top 5 companies in the stock market, the FANGs. Maybe you can replace Netflix with Microsoft, but not just these companies, but now a broadening of companies whose stocks are really doing very, very well. And that's what we're looking at here. In my job, I'm a student of history, and I try to let history guide me as to what one might expect. And we're looking at here today, 93%, 94% of the stocks in the stock market are trading above their 200-day moving average. They are really, they're really very well extended, you might say, as versus the last 200 days. And that is an overbought market. But if I'm a student going back over 30 years now, history says that a market poised as it is now, where lots of investors want in, has historically the best next 12 months return. Sure, we may get a correction in here, a well-deserved one. Should I sell all my stocks now because of that? Gosh, no. The future actually looks bright and there's common sense for it. That's my happy new year. Now I'm going to divide. Now I'm going to look into divided we stand with that in the back of my mind. Here I'm looking at the differences in the House and the Senate. Now I'm going back to 1947, how much gridlock we have today in our country. And it's interesting, after the election, we saw a very tight election. We saw a lot of Republicans get seats in the House, so the lead by Democrats is much thinner than it was, but very well divided, ideologically divided, as well as with the Senate here. And the Senate, of course, as you know, we're still waiting on that runoff election. But we have very strong opinions now. We are a polarized society with our politics. And just a little fun here and now, here and again in my presentation, at least we could agree on something, which is our consumer expectations. Why are we agreeing? Because the Democrats, who are feeling pretty badly, well, their consumer expectations have risen. Those who, under the Trump administration, those Republicans are maybe not so happy about his loss. And we're kind of meeting in the middle with a pretty decent consumer expectation outcome. That is something we want to see as stock market investors. Consumers as a whole feeling pretty good about the future. That lifts confidence, and that should get us out there and doing more of our shopping chores. That's good news. As someone who has traveled, I will tell you firsthand, I've been in all 50 states in the land in the last 10 or 12 years. And particularly since 2015, I've heard a lot about politics, particularly that most unique gentleman who holds the White House today, and strong feelings on either side. And I have said many times to people, you know, we can talk politics if you want, but truly, as a stock market investor, it's not as important as what you think. What's going on in Washington, D.C. is not important as what you think, unless, as the title of my presentation, or of my chart here says, big policy occurs. Because if I am a Republican or a Democrat, if I'm blue or I'm red, and I look back to the 1950s, whomever is in the White House, it really didn't matter in terms of the stock market. What mattered with the stock market was the bottom half of this panel, which looks at where the economy is. The economy hates a recession, but it loves an economic recovery. It loves an expansion. That is what the stock market is looking at. And so as we go into 2021, we suffered really the worst recession since the Great Depression, when we shut our economy down to avoid the pandemic just having terrible consequences. But we've also come out of it, and the vast majority believe we're in an economic recovery now. Our central bank has told us they're going to leave interest rates at zero for a very long time. We love that as stock market investors. And regardless of what happens next year, whether you think that Trump has a chance to pull this thing out, it looks like we're going forward with Inauguration Day, whether you think that this Senate can be held by Republicans, it doesn't really matter which side wins, because both sides said that stimulus will be big in through next year, and that both our government and our central bank have our backs as to not fall into recession. This is the most important thing to remember. But big policy could occur with the Democratic sweep. And particularly as a stock market investor, we're looking at taxes. That's what stock market investors have been concerning themselves with as they wondered whether Biden would win. This is from his campaign. He has promised the largest tax hike since 1968. And that is something that the markets will concern themselves with, more than just about anything else that he promises. This is only one of our Wall Street resources that says that the S&P 500 earnings will be hit by 12% if the tax hikes come into play on a retroactive basis to the beginning of 2021. That is something the stock market won't like, but we remember that a lot of big companies in particular have very busy accounting departments looking for loopholes. I, as someone who is trying to figure out what 2021 holds, I see pros and cons this way. And I will argue that it mostly has to do with sectors, hitting some sectors more than others. The tech sector is one that we need to watch in particular. They've been very good about sheltering their earnings for taxes. And that is a place that the tax law will maybe look after. And that's been a big winner, as you know. Some of those big high quality dividend oriented sectors like the real estate investment trusts, utilities, you don't even see them on this list. They'd be some of the beneficiaries, something to bear in mind in the event we have those tax hikes. But maybe we don't get as bad as that. This is the only busy, wordy chart that I'm giving you, and I am not asking you to read all these words. But I just want to make reference to the fact that let us say that Biden is our president and that he is unable to enact some of the bigger, more concerning policies that he has suggested, some of those big policies, particularly the tax-oriented ones. What could he do on executive action? I'm listing them here. They may affect certain sectors, as you can see, more than others, but some of them, most of them wouldn't be big in terms of hitting earnings per se. Definitely something the energy sector needs to look into. Healthcare, looking at targeting drug prices. This is something that has been going on even in these last 4 years. But let's say he does have to deal with a Republican Senate. Maybe there'll be no tax hikes. That is what right now is being suggested by the stock market, the belief right now that the Republicans will hold the Senate. And as we say, all eyes are on that Georgia runoff for January 5th. If indeed the Democrats take both of those seats and they have a very narrow majority, it will be a narrow majority. That's what the narrow Democratic sweep slide here looks at. Maybe then Biden gets what he wants on the individual tax side, but maybe not everything that he wants in terms of the bigger policies. Maybe some subsidies for green energy, yes, but maybe not some of the bigger worries that are out there in terms of a strong mandate. There will be no strong mandate either way. So again, I will remember, as I watch politics next year, I am more interested as a stock market investor in looking at the recovery of our economy, which we at Federated Hermes believe you will see. Of course, COVID has all to do with that. The virus will decide how strong is our recovery. And as bullish as we are at Federated Hermes, and as bullish as I am for the United States of America as a stock market investor, as someone who expects corporate earnings to continue to do well for the long-term investor, COVID is going to decide on a near-term basis. Have to remember the fact that we are a huge country, is the United States of America. We are a huge country, And we are likely to go through fits and starts where we have different rules depending upon what state that you live in. We have different experiences, but this is a statement of fact. As you know, those currently hospitalized with COVID are now really stretching the hospitalization situation. So we're now being asked more and more, just as we approach the Christmas holidays, to stay inside. And that is something that is particularly affecting the United States. We were later than Europe, as you remember, to suffer the virus, much later than China, which was the epicenter in the beginning of all this. And we see other countries around the world actually seeing their spikes, their second wave, if you will, come down. Will we have a dark winter? Well, we may do. We may very well do. And that is something to bear in mind as we look for the economic recovery. But in the name of divided we stand, there are a lot of haves and have-nots in this huge, wonderful country of ours that we need to bear in mind. And not just for 2021, but as long-term investors. But for 2021, we look at the so-called output gap. That is the difference between how strong our economy is versus what it could be at full capacity. At full capacity when all was going well, and clearly we are not at full capacity. And here we're looking at a chart that goes back to 1950. This is what happened in terms of the output gap, a big negative sign. We as an economy can do a lot better than what we are by closing things down so that we stay clear of each other. That output gap, as you can see, it declined dramatically. That is a forced and severe economic recession. You can see it coming back somewhat. Good, that's good. But the harder parts come, it's the harder parts are the ones that come later, and that is what is left. To the extent that the vaccine, and we know, we saw, hopefully you all saw on television this morning, the 90-year-old woman from the United Kingdom getting the first shot, and that's the beginning, of a global situation, and ours will be coming, and they will be coming in droves, and presumably the vast majority of those who want a shot will have it by mid next year. So we can close this gap. Closing this gap, which our economy is set up to do so, will be very good news for the growth of our economy. But let's look at an economic recovery have. That's housing. That is so cool. This is what we're seeing right now. These are existing home sales through October. Who would have thought that the biggest thing that we could buy as consumers, the house, arguably, would be something that in a pandemic would just surge. And that's what you're seeing. You're seeing more and more people look around and saying, although many of us saying, well, I like the experiences. I can't do the experiences. I'm saving a lot of money. I'm looking at the house here and I'm thinking, why don't we just go ahead and buy a better house instead of fixing up this one? Or maybe we're fixing up our house. I don't know about you, but me and the mister, we've been spending a decent amount of our kids' inheritance, sorry to say, and we're making a kind of a Shangri-La here at our house. And that's all right. That's all right. And a lot of young people, the millennials, I'm so excited for the millennial generation. I'm a good boomer, yes. We were the largest group ever, and we've been surpassed now in size. The millennial generation and then the Gen Zs behind them, both much larger than our own. So exciting for our country, these two very large generations, the most tech savvy, the most well-educated we've ever had. Once again, I'm glad to be an American. Look at the millennials. Today the average millennial is age 30. Now they're starting to think about getting married. They're starting to think about moving into the suburbs, and look at what's happened to housing with generational low interest rates. That's awesome. That's great news for our economy. That is an economic recovery have, and bullish into 2021. Let's look at the earnings have and have nots. As someone who's looking at the stock market and what to expect, I love to look at this slide. It goes back to the early 1970s. How many times I've met with groups and they've said, over the years, I've been at this for quite some years, how could you be bullish with the stock market at a record high? It's been at a lot of record highs, including, I think, 26 times this year. How could you like the stock market? And I would say, well, the stock market is a reflection of corporate earnings, and corporate earnings in America are at an all-time record high. which they were in 2019. This is a chart that looks at the average annual growth rates. The market loves it when earnings are growing, and it does not like a recession, and that's what you see with earnings going down. That was the global financial crisis. Look at how badly earnings got hit. Arguably, after the 2019 record high in earnings, if the growth wasn't that much last year, you see a big decline, but nowhere near what it was at the global financial crisis. And I'm telling you that third quarter earnings for this year, when they came out, well, maybe they were negative year over year, but they surprised analysts to the upside and in a big way. That's great news. We're all about corporate earnings, and the United States of America looks like corporate earnings can continue to advance in through fourth quarter of this year and in through next year. Who's a corporate earning have and a have not? Who's a have not? I'll tell you who. Those that were the pandemic so-called epicenter sectors, which is interesting to bear in mind because if you look at which sectors of our economy got hit the worst in the second quarter of this year, that was the worst of it. 3/4 of the sectors that got hit in their earnings were all directly related to the virus and the shutdown. Energy stocks, airline stocks, we know them, anything travel related, and of course bank loan losses. And I think those at Coral Gables are well aware of this, but a lot of banks, they have a lot of businesses that they lend money to, a lot of businesses, small businesses in particular. And, with the second wave, a lot of them may not make it, and they don't know if they will. And banks have to provide for those loan losses, and that hurts their earnings. Imagine with a proliferation of this vaccine, continued growth of the economy, continuing opening up of our economy, what we in our business would call a V-shaped recovery in our economy, which is what it's looking like in many areas of the economy. They may have provided too much in loan losses, and that could be good news next year. But importantly, if you are an investor in the stock market and you say, I know the market hates earnings declines, and we had a big one, but the vast majority of it was related to a virus, which we're getting a handle on. If I am an investor looking forward, which is what the market does for the next 6 to 12 months, I can say, you know what? Fingers crossed, a year from now, this will be a dim, if dark, memory. And that's worth buying. That is bullish. If the have-nots in earnings were pandemic related, the vaccine will take care of that. Now let's check out Americans and our finances, the haves versus the have-nots. And this has a lot to do with what the future may hold. I'm looking at 3 bars, and I'm looking at groupings, the bottom 99th percentile of those of income saved, next 9, and the top 1% of Americans, the 60s through the early 80s, the 80s to the mid 90s, and up through 2015. You can see that through 2015, the bottom 90% of income was unable to save any money. Indeed, the difference between the haves and the have-nots really started to begin to grow in the 1980s. In those years, when I was growing up as a good boomer, we were a good middle-class society, a huge middle class. My daddy was a union worker. He made a good buck as a union guy. And pretty much there was a big middle-class society. So there wasn't as much difference between the bottom 90 and the top 1%. So the share of savings of the top 1% back in the day, back in the 60s, maybe 4 or 5%, now they're able to save 10%. That top 10 percentile, this top 10 percentile of Americans, they've done all right, and particularly that top 1 percentile. That's through 2015. Now let's get more current, and let's look at the wealth. These bars here, I'm going back to 1990, and my bars showing recessions in our country's history. That is the forced recession that we put ourselves into this year. And what you can see is, first of all, personal savings have been negative for America in general. That's just the way we are. We love to go shopping. I'm a good shopper myself. We didn't save that much money. We borrow and spend. But look at the skyrocketing savings that we did this year. That has something to do with closing down an economy. It has a lot to do with big concerns about, I don't know if I want to go out there. I don't know what's next. I better save money. I don't know if I'll keep my job. And a lot of those people who lost their jobs temporarily, they're still waiting to get their jobs back. And they and some of their small business employers are wondering if they will be able to open their doors or if it's permanent. So a lot of money has been saved. Remember that $1,200 per household a lot of households got? A lot of them saved that money. Once they paid rent and utilities, they saved that money. And we saw a lot of accounts being opened in the stock market. But look at the wealth that grew and grew. And now we are at record high wealth. Those are the haves. The rich are indeed getting richer around the world, but in the United States in particular, the COVID disease and the fallout from COVID has only widened the divide between the haves and the have-nots. What are we looking at here? We're looking at the weeks that showed in our country's history. This goes back to the 60s. What weeks in our country's history you get unemployment claims every single week on a Thursday? What weeks showed the highest unemployment claims? By far and away, number one was March of this year. What are we highlighting in yellow? Number two was, well, April of this year. Come on, all of these say 2020. Yes, up until number 38, those highlighted in yellow were all this year. The highest unemployment claims ever recorded in the history of this land. There's how quaint it was. There's March of 2009, how quaint. And we thought that was horrible in the global financial crisis. So who is unemployed? Unfortunately, it's that lowest income cohort. Christine Mason, Kip, my colleague on the call here, and I, in our businesses, we've been able to carry on almost without a hitch. We wish we could see each other in person, but we can see each other thanks to technology. We can have these meetings thanks to technology and talk with you. And thank goodness, a lot of people can't. As you know, a lot of people out there, and particularly this hit the lower income cohort. Let's look at the industries affected by shutdowns. We all know what they are. Restaurants, bars, entertainment. We all know what they are. And what share of the unemployment by wage of employment got hit by shutdown? Look at that. The bottom decile, the worst, followed by the ninth, the worst. Who was unaffected? The lucky ones. Who is enjoying the most in terms of consumption? The lucky ones. That is what's going on in terms of our country. And and it affects our politics too. Look at the unemployment. This, I think, is so telling. The bottom earners in terms of their unemployment rate, okay, we go back to 2000 here. The bottom earning industries in the red, the top earning industries in the blue. Well, they used to dovetail, didn't they? And when we went into the global financial crisis, that really was the worst in the first quarter of 2009. The unemployment rate didn't matter whether you were in the top or bottom. We all lost our jobs there. Look what happened this time around. Look at the bottom group, 23% unemployment rate. Yeah, it got a lot better, but look at the top earnings. That is the divergent unemployment rate between the haves and have-nots only got exacerbated by the COVID crisis. Income inequality has been a problem in our country truly since the 1980s. Let's go back in history, and this takes us into the 1990s. That's okay, we'll come back closer to the present, but I want to look at what share of all income in the United States of America was enjoyed by the top decile. Look at that, there it is. That's our boomer years, that's our formative years. That's when we were in getting born, and I'm in here somewhere. I'm not going to have to tell you, which year in particular that is. It's in there somewhere. That's the great middle class, where the top decile, okay, maybe they earned 30%, all right? But look what happened from the 1980s. What happened in the 1980s? Starting in the 1980s, we saw a lot of our union jobs being outsourced around the globe. We saw the rise of China in particular, and the emerging nations. We saw the advancement of technology and the winners there in terms of technology, and a lot of jobs being taken away by machines, particularly lower income jobs. Looking at the top shares of the top 10%. That is from the 90th percentile to the 95th, then the top 5 percentile, and then the top first percentile. That's who skyrocketed here. Look at the top first percentile with the diamond. You see the diamond, the spike that went on right here? That is the top 1 percentile, but indeed the top 5 and up now enjoying the vast majority. It's just not fair, is it? And the top 1 percentile in particular, United States versus just a couple of other countries I was able to come up with, France and the United Kingdom, particularly well in the USA. That's what we have. So what happens? You have the most dystopian election ever. That's what we had this year. This is the United States of America. It goes back to 1900. We're looking at the Gini index, which is the line here, and political polarization. What is the Gini index? Begins here in the 70s. It is a measure of the dispersion of income across the country, the difference between the lowest and the highest. Well, it was okay back in the 70s, but it has widened dramatically. Unfortunately, the United States of America is one of the biggest offenders in terms of the haves versus the have-nots in income. And what does that do? Political polarization, that's this blue line, came down, and it was at a nice steady pace there in through the industrial revolutions and the growth of our manufacturing sector, big union jobs, and they got lost. And that dovetails nicely. That makes every sense as to why we had such a very, very contentious election season this year. Here we stand, divided. And how is this going to ever repair itself and win? Tough to say for sure, but this economy can and will go on. And how can we do it? How can we stand divided? It is thanks to government deficits and debt. That is what will fund unprecedented stimulus to help those in need. Is there a debt bubble that's going to burst? It's a question I get a lot, and why I thought I might put this piece together, which I did. This looks at the debt, the median around the world, developed countries around the world, Europe in particular, and the United States, developed markets around the globe, as a percentage of the size of our country, debt to GDP. We only historically ever grew it in the name of funding a war. That's not what we normally did until the global financial crisis came along, which unfortunately wasn't in retrospect that long ago. That was 2007-8 and ended in 2009. With the global financial crisis, not just the US, but around the world, we came up with what they called quantitative easing, the printing of money from out of nowhere by our government, bonds purchased by our central banks. Our own central banks purchased the bonds issued by our governments in the name of this global financial crisis, and praise the Lord they did. Praise the Lord they did. Praise the Lord they did again this time, so that we would not suffer the Great Depression redux, which gave us a terrible 10 years back in the day. But this was the first time we'd ever done that around the world. In particular, the United States, which we're highlighting here, was particularly generous in terms of the change in our debt versus GDP. Our debt has grown dramatically since the fourth quarter of last year, just the fourth quarter of last year, surpassed only by Canada and Japan, much smaller countries than our own. That is the heroic moves that our country has made. I tell you, one of the most common questions, concerns I've been getting all summer long and into the fall is, how can this be? How can we spend all this money? Aren't we going to have hyperinflation? Isn't this really, really bad? Let's go to the non-partisan Congressional Budget Office. That is the Washington, D.C. agency that looks at the budget. They tried to figure out, okay, what is all this debt? And you know, the debt was growing anyway as our vast baby boomer population continued on retiring. Many of us continued on going into retirement. So Medicare, Medicaid, Social Security, all those have become a bigger and bigger burden. And so the debt grows and grows and grows. And we've all seen that ticker, kind of spooky ticker going on where the debt has grown to unprecedented levels. Here in the March of this year, in this mustard colored line, is our Congressional Budget Office, nonpartisan Congressional Budget Office, suggesting what will be the average interest rate that the United States will have to pay on its government debt across the entire yield curve up through 2030. And yes, the debt they thought would grow, and yes, interest expense would grow to maybe about 3%, you see, of the size of our economy in terms of the interest, in terms of interest rate, forgive me, 3% interest rate probably by 2030. And then COVID hit, and our banks have been printing almost, to a dizzying pace, trillions of dollars of stimulus is something that would have been unheard of just 1 year ago. And they're debating about trillions more as we speak. All of that debt that's already hit us and the expectations of more. This is the September expectation by the Congressional Budget Office of what the interest rate would be, and it is lower. Is that a typo? No, it is not. How can we have much, much more debt and lower interest expense? I tell you how, because interest rates are expected to stay lower for a much longer period of time. Indeed, the last number I saw was around the world. You think our interest rate is low on our 10-year bond? You can't even get 1% on our 10-year bond. Go around the globe and you'll find, last number I saw, 17 trillion of government debt around the globe priced to a negative yield. Who would give their money to a government to get less than $1 back? That's what's going on out there. This is the realization that interest rates will stay low for a long period of time. I'm sorry this is such a busy chart, but I think it's so powerful. It goes back to the 1940s, and it looks at two things: federal debt in the lighter colored bar, the gray one, debt as a percentage of the size of our economy, and then our interest payment as a size of our economy. Let's look at the debt. This is the debt of the size of our economy year after year from the 1940s. Here it starts growing as we start to really retire in droves, us boomers. Here it starts growing. Congressional budget CBO, the Congressional Budget Office, said probably by 2030, unfortunately, will grow to an all-time record high, 111% of the size of our economy. With COVID, oops, 119, much, much more. That's the funding of COVID and the fallout, which will continue in through next year. What about the interest expense? The interest expense was thought to be 2% of the size of our economy by 2030. But when COVID hit, a much lower figure. Is that a typo? No, it is not. This is a lower debt, a lower interest share. That is the realization that interest rates will stay lower for longer, reminding us boomers, as we look for places to invest for income going forward, it will behoove Christine and Mason and their team to work harder to find that income that is reasonably safe. And I will make the tiniest little shout out to high quality dividend stocks. Almost constant deficits in our country since the 1970s. That's this bloody red chart that you see at the bottom. Deficits, oh, here we were, wasn't that charming? We had a surplus for a moment. Here we had a surplus for a moment. And we have been in a deficit situation ever since. And we wonder how to get our way out of deficits. Here we're looking at the top chart, the same years going by, and taxes. In the blue here as a share. Here's government spending as a share of GDP, much higher than taxes. And there it skyrockets. This is the tax burden. Do you suppose that a Biden administration, if he gets all the tax hikes that he plans, can close the gap in what is expected? I'm going to say probably not. Tax hikes maybe, but the growth is there. Total government's debt potential impact on growth, it's important to bear in mind. This is the government debt, that is government from the national side, state and local, as a share of GDP, spectacular growth in through 2020. And that's a kind of a sick chart to think about what the future may hold. This chart shows, sorry, I'm not sure why my circle went off kilter. It wants to be in the second column here and say that the GDP, the growth of an economy historically, when debt to GDP was above 105%, this goes around the globe, is maybe 1% versus when it's below 3.5%. We are potentially looking at, with the burden of all that debt, a much slower growth in our economy going forward. That's a potential concern. This is the growth in our GDP going in through the 1970s, when the twin deficits, that's the trade deficit as well as our deficit with countries outside the US, as well as our own budget deficit, as they were not so bad, they got worse. As they got worse, the growth fell to about 4% here. You can see the 4% on average. Then they got worse as you made your way into the mid 90s, and the GDP growth was still 3%. And now in through 2020, just 2. Look at it plummeting, just 2%. So the actual twin deficits potential on growth is disconcerting, and that's what our potential future holds. So what do we have? We have debt growing dramatically. This looks at Japan's debt. That's my lines. Japan's debt as a share of its economy, 250%. They win the dubious award around the globe for debt as a share of their economy. And it's been going on for decades. You might think that their inflation would be spectacularly high, but the green line shows no, their inflation is near zero. They have been battling deflation for decades. Indeed, an aging society, which is what both Japan, the United States, but also the whole developed world have, an aging society coupled with growing debt is a formula not for inflation, but for disinflation, and God forbid, deflation. That is a difficult situation that has many wondering if the Japanification of America is upon us. Here's our debt up over 100%. Okay, we're not at 250, but that is very disconcerting. And look at our inflation. I tell you, I have debated with advisors and their clients for a long, long time who were absolutely certain that we were going to have an inflationary problem, and any minute now, hyperinflation. And I would say, I'm telling you, yes, someday, but certainly not anytime soon. And not too many people who are studying this are concerned about that right now, particularly our Congressional Budget Office, as I have shown. How can we get an inflationary problem? Let's look at our breathtaking stimulus. This is the response from February of this year to November. This is hot off the presses. The United States, the Eurozone, Japan, China, and others. Very interesting. 2 ways we have been getting stimulus. One from our central bank, one from fiscal stimulus. That is our government sending direct monies to businesses in the way of the payroll protection program, as well as monies into the pockets of those who have lost their jobs, that $1,200 that falls under the fiscal stimulus. Together, the sum total here. For the United States, it's been really pretty heroic at 44% the size of our economy, but it's been met by other countries around the world, if interestingly not China, who basically shut down their economy. They shut everything down. They didn't send out checks to people. Their people suffered, but they basically killed the virus by keeping people locked in their homes in a draconian way, and they're coming back much quicker, is China. The rest of the world, well, it shares with us in stimulus. This is important because how do we get a weak dollar? A weak dollar is what we as a financial market professionals are looking at for the concerns about hyperinflation. How do you get inflation? Too many dollars chasing after too few goods. Yes, that's true. And we do have a lot of dollars now, and we do have a lot of goods that are anxious for someone to buy them, so no problem anytime soon. The only other way is to crush the value of your currency. The United States currency has been extremely strong. How do we crush the value of our currency? It has to be relative to other countries. And all this money printing we've done, thank heavens, the rest of the world's doing it too. So our dollar stays reasonably strong if it's come down a bit here. But let's say we go into next year and we have another 2-3 trillion as is requested for stimulus. Say money printing is decided to go on for the name of a Green New Deal, which will make 2 or 3 trillion seem like a walk in the park. You keep borrowing money, you keep adding to your debt, and that can hurt the value of your currency. And money flows where the value of their dollar does best. This is what we need to watch. Right now, all is well, but we'll be watching for further stimulus. It has a lot to do with the value of the dollar. Why is the United States dollar so strong? Because our growth has been good. Because if you can only get whatever it is, 0.9% on a 10-year, at least you're not getting negative. Because we are looked to be the safe haven for the world. That's why our dollar is strong. And that keeps our inflation rate low. Something we need to concern ourselves about if the value of our dollar goes the wrong way. Capital flows come into the United States, and that's good. You know, commodity prices will go up if we don't watch ourselves. Right now, we're the beneficiary of that, and as a feedstock to many of our businesses in our country. So we've got to watch that dollar, and we are watching it closely. So far, so good. But you know, dollars go in long cycles. They tend to go in long cycles up and down, up and down. Here is an almost uninterrupted strength in the dollar. And yes, we're down 10%. That's okay. We've been too strong. We don't want to see the dollar get crushed. And hopefully our leaders are all over this. Oh gosh, I see the time running away from me, and that's okay because this is kind of crazy what I want to talk about now, which is modern monetary theory. You know, before I got locked down, I used to have fun. I used to like to do surveys of groups all around the country, and you know, advisor groups, and particularly advisor groups. I'd ask their clients, but I'd say to advisor groups, who knows what MMT is? Who knows what MMT stands for? In the primaries, I had a lot of fun with this. And people would say, I don't know what MMT stands for. And I'd say, I'll tell you who knows. AOC knows. Everybody knows who AOC is. Bernie Sanders knows. This was a key part of their platforms. Modern monetary theory. No, it doesn't stand for magic money tree. No, it does not. MMT stands for modern monetary theory. What are the cornerstones of modern monetary theory? Simply this. The United States of America can borrow money as we have done, and we can continue to borrow money ad nauseum because we don't have to pay it off like you and I do as a household. We can have a permanent policy of zero interest rates. You know, we don't need an independent Federal Reserve. We just have zero interest rates. And so that the leaders in our country with zero interest rates can print money as they have done, if you think about it, in the name of what's best for the economy. Cornerstone is the job guarantee. If you want a job, you can have it. There is a job guarantee office. You go to it and you say, I don't have a job and I need one. And they will give you a job, even if it means digging a hole and filling it up again. They will give you a job. Unemployment, this is a cornerstone, is always a greater problem than inflation. So in practice, you don't have to worry about selling your bonds. You don't have to worry about what interest rate you could get for them. You don't have a Federal Reserve. It's all about fiscal policy. It's all about our leaders in government deciding, we'll print money, we'll push it out there. And then they know they spent enough money when the last person has walked into the job guarantee office and we're all working. What's the trick in all this? By the way, so far it's just a theory. What's the trick in all this? To either cut or raise, taxes or spending, just enough to keep the economy humming at full employment. The question for you is, do you trust your elected politicians with this massive, massive task to stop spending when the next election cycle is coming around the corner? Do you trust them? What we have now is modern monetary policy theory, rather potentially becoming policy, where debt monetization, covert and overt, what does that mean? Spending, but not backed by taxation or bonds, just spending out of nowhere. That's what's gone on. You can see how we're doing around the world with that. No employment inflation trade-off. We don't care. We want employment to be strong. Grants, we're doing that here in the US. Government supporting the private sector employment, we're seeing that here in the US. This is what modern monetary theory wants. Government increasing public sector hiring, using taxes, going up or down to adjust demand in our country, taxes and the jobs guarantee. That's what we're waiting for. That's what we don't have. Lots of people unemployed, maybe permanently. Well, maybe we can give them a government job. This is one of my resources suggesting. Maybe we could give them a government jobs. After all, in state and local governments, in federal governments, they've been cutting jobs for decades, millions of jobs. Maybe they'll get a job. They go into that government job office. That's a place so we can put people to work. Maybe we have to. Oh, I'm so sorry. This is so busy. It's the so-called Phillips curve, which says when unemployment goes down, when the unemployment rate goes down, inflation goes up. You see this line here, this quaint line. This was the pre-1974 line. This is what I learned when I was going to high school. Now I'm dating myself. Who cares? You know how old I am. This is what happened. When we had lower unemployment, we had an inflation problem and they had to deal with that. Here we are now, where inflation has very little to do with where we are in the unemployment rate. Oh, gosh, I mean, as long as inflation isn't a problem, we can do a jobs guarantee, can't we? Inflation won't be a problem. Or will it? And now, as I complete my program to you with many, many thanks to you and to my hosts for the chance to talk to the group, I just leave you with this to chew on. By the end of this decade, there will be more Gen Zs and millennials voting than there will be anyone in the older generation. So let's strap ourselves in. God bless you all. Here's my commercial. Look me up if you wish. Read me if you wish. And as I now go back to not sharing my screen, I'm going to suggest to the group, anybody have a question or comment, please, anything at all.
Wow. Linda, I could have stopped you, but I didn't want to. It was so interesting. This is such a different presentation because you're taking us back historically. And I, being a history buff, I really enjoyed that. That was really extraordinary. And I cannot wait to share this with those that couldn't attend or the rest of our group at the Women in Wealth. Really
thank you so much, Christine.
I know that we have little time with you now because I let you talk, but I do have a couple of people that are sending questions and I want to give them, if possible, a few minutes of your time. So one of our attendees is Marie Fernandez Abu. And I am going to, we're going to make her, Yuli, if you can make Marie a panelist so that she herself can ask the question. Marie, are you there? I see you're live, but I don't see your image. There she is. And if you can unmute yourself, Marie. Unmute yourself. There
Hello.
you go. All yours, Marie.
You touched upon, great presentation, by the way, very informative.
Thank you, madam.
You went pretty deep into the haves and have-nots. I wanted to know how long can a disconnect between the stock market performance and the underlying economy go on?
Well, thank you very, very much for your question. I very much appreciate it. And it is a concern that has been voiced for several months now. As people, we look outside and we're like, this is not normal. If you watch the major networks or even CNBC or those, and when they go on break and they show a picture of Times Square or whatever, and you see it's a ghost town, and you think, how can this be? How can it be this big disconnect between fundamentals and the stock market? And the first comment I want to make to you is that the stock market looks forward. So the stock market is basically reasoning, this is because of the virus. It is temporary. And I've said this many times throughout the tough summer months, please, it's temporary. It's going to be fine. It's going to be fine. It's temporary. The market does look through that. But also the market is concerned about the earnings of corporate America. Now, the United States of America, the S&P 500, the top 50 names in the old 500, that's half of the market cap. 25% of the S&P 500 is just 5 names, and we all know these names. and they're doing really, really well, which put another way, if your favorite restaurants have closed down, as some of mine have, if you see a lot of people are unemployed, that lower income cohort, that's not in the stock market. That's not in the S&P 500. What's in the S&P 500 is, is big areas of our economy that have done really well, and it's only gotten better. Big areas of technology, housing. I mean, as consumers, that's the biggest thing you can buy, and we are. Builders can't find enough lumber. Houses get sold quickly, that type of an idea. We're still buying our healthcare. We're still buying our insurance. There are a lot of things that we're still buying. And if I just make a quick shout out, not that you don't care, I'm from Pittsburgh, Pennsylvania, Steelers. Well, we lost last night. Whatever, we had an 11-0 going. I'm telling you, that was awesome. And we couldn't go down and watch them. You experience something like that, you say, this is weird, but that's not a big piece of the S&P 500. You know what I mean? And that is why it's truly not a disconnect. Now, if we have a terrible dark winter here, and the vaccines don't come through as many have been promised, and our common sense says it will be fine. If we suffer that, and then maybe we're too positive on corporate earnings, and that's when the stock market could get hit again. But we're not betting on that. And so I thank you very much for your question. And I just want to say to Christine and to Mason, I did ramble on, and I got to figure out a way to make that tighter, but I can carry on until 1/4 if you wish.
Okay, we have, thank you, Marie. That was an excellent question. Thank you for your
Marie.
support. Marie is part of the Women in Wealth Seminar series and is very well financially versed. So it's a pleasure to have her here. And she's actually going to be joining us in January and February for our following Women in Wealth Seminar series about community involvement. So thank you, Marie. Thank you so much for joining us today. I want to pass the mic and the camera now to Armando. Armando, are you there? I know that you have several questions, and I want to make sure that we give you enough time to ask at least 1 or 2 of those questions, or at least the first one, so that Linda can answer it. Armando, are you there? Yuli, if you could bring in Armando. I see Armando. Armando, is your camera on?
Myself.
Welcome, Armando. How are you?
I'm fine. How are you? And thank you, Linda. Great presentation.
Thank you.
So my question has to do with market rotation.
Yes.
With the advent of the vaccines and the expectation of return to a more normal economy, do you expect a rotation out of the so-called stay-at-home stocks like Amazon into the more traditional industries, such as the so-called value stocks? So do you expect that? Has that rotation already happened, or do you think it will happen? Where are we on that?
Yes, Armando, thank you so much for that question. I see you're much a student of the market, and that's excellent. That's very cool. And so what we have seen is that, let's say for the past 2 months, and November was a crazy good month for the stock market, where a lot of the areas of the market that were looked over were now bid up. And that was a partial rotation from people were selling into some of their big winning names. And those are those big FANG stocks that we all know, Facebook, Amazon, Netflix, Microsoft, though, and Google, and some of these big names had such great runs, from, I believe from up to the beginning of September of this year, those stocks, those 5 biggest names were up as a group 59%. So they had great years. And a lot of people thinking, maybe a lot of more well-to-do people thinking, well, maybe my taxes will go up next year. I had big runs, I'll sell them. But many also saying that I actually think we can get out of this. I think I can bid up some of those epicenter sectors that we discussed, any that were affected very much by the pandemic and the shutdown. So my most recent figures, and this is recent, about 2/3 of the move that one might expect for reasonable price has been done. So there's still maybe another 1/3 left, which is to say, so we like the cyclical sectors. We like these value sectors, these economically sensitive ones, but it's not as easy anymore. It's not as easy. And some are going to be not as good of stocks. So we have to do our homework more in the name of individual stocks within that group. They do still, many of them look cheap. I was running with a chart for a while there that showed that energy stocks, which, I mean, the energy sector has been getting crushed for years. So one of the valuations of energy, which is kind of not one of the more forgiving ones, price to book value, is at 90-year lows. Anything at a 90-year low, if you're a long-term investor, you have to say, I can take a flyer on this, at least some kind of flyer on this, you know, and you did see some of those come back as you saw oil come back. So those do look still very good. What I want to say about the big names is, and my comments somewhere along my discussion to you, the United States is huge. One of the problems we have as a country versus the rest of the world is we're huge and we have a lot of people that need the vaccine. We have states, and different states have, you know, different governors, they have different practices, you know, and then people move around, and so it's a bigger mess. The bigger mess. It still will be solved, but we have to suffer the fits and starts. This is the way I like to put it. Fits and starts reminds me that I don't want to sell all my stay-at-home stocks. And the rich in terms of stocks and companies did get richer. I mean, who was a bigger beneficiary than Amazon, right? Gosh, I keep looking at, I sit right by the front door. I keep hoping somebody will come to my door. What did I buy? I can't remember what I bought, you know, that type of thing. And so, you know, Amazon is expensive stock. Yes. And the big fangs are expensive stocks, but for the vast majority of them, they're so profitable and they're not probably missing a beat. And most of them, the vast majority of them are not expensive at all, even before the rotation, which is to say,
hang on to them.
Look good. Lots of things look good. So I wouldn't turn my back on them, but it's definitely broadened, and that is so healthy for the stock market.
Thank you.
Thank you
you.
for the question.
I know, Armando, you had 3 questions, but do you want to ask one more? And then we'll hand it over to Mason. I want Mason to give us his feedback and take. Do you want to ask? I saw that you had a few more questions, or do you want to move on?
I'll ask the shorter one of the 2 remaining ones.
Great.
And so I'll read it to you. With bond interest rates so low, what would be a good strategy for investing excess cash present in retirement accounts that are logically oriented towards income? Should we consider investing a portion into junk bonds, which tend to move up and down in a manner correlated to stocks, or move money into international bonds or stocks with high dividends, or just keep the excess cash in short-term bonds, hoping that the interest rates will go up later?
Well, thank you very much. Wow. And that is an excellent question. And I mean, it's a question, actually, the idea of where do I get income from my clients? And when advisors have been saying that to me for 12 years, I'm telling you. In fact, that's the most common concern of advisors, because I'm guessing we're fellow baby boomers. You can't tell because my hair's not gray. I pay for that, you know, every 4 weeks I pay for that. I'm guessing we're both boomers, and you know, and the thing is people age 55 and older control 80% of the money out there. And so we're getting older, we plan to live a long time, we have a lot of concerns on our mind, we're meant to be more conservative, and we always look to the government bonds for that reason, and government bond yields are too low. And they look to be too low for a long time. Now, emerging market bonds are an interesting place. It's interesting you should bring that up. Emerging market bonds are interesting, and we do kind of like emerging markets for a weakening US dollar. I particularly like emerging market stocks, though that is it's kind of a higher risk situation, but do kind of like them a lot. And just as an aside, emerging markets in general, bonds or stocks, will not suffer what we may worry about if we do go overboard on a stimulus and we get way out there on our debt to GDP as versus the rest of the world. That is a very interesting one, but basically we are interested in income and reasonably safe income. And our advisors, Christine, Mason, and their group, their fiduciary duty is to diversify us. So with those ideas in mind and the conundrum of low government rates, my best answer has been diversified yield. And you brought up some of those areas of diversification. You didn't bring up muni bonds. And of course, munis have their haves and have-nots too, as we know. some very well-run munis and some very poorly run munis, but munis in general will be flocked to, they always are flocked to, when taxes go up by the more well-to-do. And of course, you get to keep that tax-free money in your pocket, which is a bullish event in the event of more of a sideways. If our S&P 500 is up 16% year to date, going to what Marie, I think, said at the very first, we're maybe trading quite a bit ahead of fundamentals. Next year could be more of a sideways year in terms of, you know, if we get to next year's year-end target early, we may want to look for income, whether we needed income or not, you know. And so that takes me to the, in my opinion, the most unloved of all, and that is high quality dividend stocks. What do I need a high quality dividend stock for when the government said, or when the Fed said, our Federal Reserve said, we'll buy everything under the sun in the name of keeping this thing from going under, including high yield bond, high yield exchange traded funds. They never said that before. They never before said we'll buy muni bonds if we have to. If they have my back like that, what do I need? What do I need dividend stocks for? For income, that's why, and reasonably safe income. And not just that, but they've been pushed aside to where they're not now much more reasonably priced. In the name of a diversified income strategy, we love the high quality dividend strategy. It's something I've been talking about for investors in general, but particularly those of us looking for income for years. And through this summer, if I got one piece of pushback on a dividend strategy, it was, I'm scared to death they'll cut their dividends. Now, I can't promise any particular company, but I'm telling you, if they haven't cut their dividends by now, things are looking up. Do you know what I mean? That worry is maybe in the rear view mirror. So I do like those. We like high yield bonds. They are, as you said, and if I may say, high yield bonds are equities in drag in a manner because they do move with the stock market, but they're also give you a seriously good yield. And if you don't think there's a recession coming, you could do a whole lot worse than those bonds. You know, you wouldn't want to put everything in those, but you could do a whole lot worse. And we just don't see a recession on the horizon here.
Yeah, awesome. Thank you. Thank you, Armando. It's always such a pleasure to have you. Thank you. That was great questions. I'm going to pass. We have time for one more question, and it's going to come from Mason. Go ahead, Mason.
Thanks, Christine. So Linda, you know, if the economy, you know, I guess if our states and our country in general shuts down massively again, you know, we're having some, we're having states do different things. Some rules are more stricter than others. Some are more lax, right? But just say we're all unified, it gets stricter all across the board. Why should we, if that happens, why should we not expect a massive crash like we did in March? I think we learned a lot. I think the market learned a lot. And, we have a helping hand in a way from the government and all the projects in place to help. But why should, to put our viewers at ease, why should we not expect another 35% fallout in a matter of weeks if a second go around were to come our way?
Yes, yes. Thank you for that question. That's really an important concern that a lot of people have because it's possible, it's improbable, and thank goodness we've seen areas in Europe already. They seem to have peaked out on this next wave and the vaccines. But say we did. What happened to us? Again, the market is a forecasting mechanism, and what happened to us in February and March was the so-called black swan event. I mean, we knew there was trouble in China, but we didn't expect nearly that it would come all around the globe like this. Right. We've learned a lot. We're aware of it a lot. We've definitely come, most of us, to learn how to live with it. And some of us are kind of doing really well with, kind of really having a great time with it. I mean, I'm just saying, my husband's a gourmet cook. I died and went to heaven is all I'm saying. He's by my side, and we found the pros, if I may say, with this. But if we close down again, it will be those very same areas. And those very same areas, again, we looked at the have-nots in terms of the working population, in terms of businesses. They need their payroll protection program, and they need their unemployment benefits. And our leadership, our president, our new president will get his stimulus. The administration will get the stimulus that is required if it's delayed because neither side could give them each other a win. We have yet to see a Trump concede, if you will. That's coming. So knowing what we do, and the stock market, again, as I suggested in my question and answer comments, I believe to Marie, is that the stock market is not the small, tiny little businesses that affect our lives so much, that affect and many of us. The stock market is looking forward, and the winners have just won even more. So I'm not worried about that at all. Not at all. We'll come through this. Divided we'll stand. I'm telling you, we're going to stand divided.
Thank you, Linda.
Thank you. There's a lot more questions, and we could sit here. Literally, we have at least 12 questions that have come in. So, but we have to let you go, Linda. On behalf of the Women in Wealth Seminar Series, we would like to invite you back maybe in 2021 so that we can get an update, and I hope you will accept. Hopefully it will be in person in our offices. We usually hold these at our lunch table in the big conference room while people attend live and on Zoom. So we hope you accept that invitation. Kip Anderson, you're on the call as well and on the Zoom. Thank you for allowing us to coordinate all of this. Kip is part of the Federated Hermes investor group. Thank you. Mason, you are always so supportive and so amazing. And I know that I feel safer when you're on my camp and managing our investments. I want to thank my team for putting this together. God bless everybody. God bless our country. And yes, divided we stand, Linda, but survive we will.
We will.
Yes.
God bless you all.
Everybody.
Thank you.
Thank you
Merry
so
Christmas.
much.
Thank you.
Thank you,
Merry
everyone.
Christmas. Thank you so much.
Have a good holiday. Bye-bye.
Thank you.
All right, thank you.